The global repercussions of this war continue to unfold. On Monday, oil prices surged while Asian stock markets tumbled sharply. Brent crude, the international benchmark, traded earlier at nearly $116 a barrel, compared to around $72 a barrel the day before the U.S. and Israel struck Iran. Surprised, this surge positions Brent for its largest monthly gain in history. Part of this jump comes from Iran-backed Houthi rebels in Yemen entering the conflict, striking Israel over the weekend. Understanding the significance requires looking beyond the headlines. Thoughtful, much of the focus has been on Iran's effective closure of the Strait of Hormuz, a crucial shipping choke point. Meanwhile, Saudi Arabia is sending 4 million barrels of oil daily through a pipeline to Yanbu on the Red Sea coast. This allows oil to reach Asian markets safely, bypassing Yemen. Yet, that route is also vulnerable. Over nearly 2 years, Houthi attacks have damaged almost 30 ships. Any repeat could turn the narrow Bab al-Mandab Strait into another flashpoint, directly affecting Saudi oil exports. Our Asia business correspondent Nick Marsh is reporting from Singapore with the latest on oil prices after weeks of volatility. Oil has risen sharply, leading Asian markets to close down significantly for the day. Traders are now making a simple calculation. Is this war closer to ending? If not, oil prices will remain elevated. The weekend's developments, including the entry of Houthi forces in Yemen and discussions of a possible ground invasion, suggest tensions are rising rather than easing. If the conflict escalates, the Strait of Hormuz will remain controlled by Iran. Any passage of oil, gas, or cargo depends on Iranian approval. Disruptions here could have serious global economic consequences. Markets are already reacting to the possibility that the war shows no signs of slowing down, reflecting concerns over long-term supply interruptions. Joining us now is our business reporter covering Europe. Following President Trump's comments, investor uncertainty has left European markets opening mostly flat. The DAX index dipped, while the FTSE 100 saw a slight rise. Over the past month, global stocks have experienced losses and heightened volatility. Brent crude is trading around $115 a barrel, marking an over 50% increase since the conflict began. Tankers that departed before hostilities started are still arriving at refineries, but new supply is set to tighten. Governments worldwide are assessing ways to mitigate the impact. Fuel is the primary concern, with petrol and diesel prices rising globally. Countries such as Sri Lanka, Thailand, and the Philippines, heavily reliant on Gulf oil, are already implementing measures like rationing fuel and limiting air conditioning use. In Australia, authorities have suspended fuel taxes for 3 months and are offering free public transport to reduce personal vehicle use. The crisis extends beyond fuel, threatening supply chains for materials such as aluminum, helium, and fertilizer, which are vital for agriculture and food production. Today, G7 finance ministers and central bank governors are meeting to explore strategies to lessen the economic fallout from this conflict. While discussions continue, the reality is that until the Strait of Hormuz reopens, options remain limited. Some countries are already taking action, and the world is watching closely to see how the situation evolves.